Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. Hey everyone, we've got a new modular focused podcast called Expansion launching on the Blockworks network. We're airing the first episode here, so I highly recommend you give it a listen and then head over to Expansion and subscribe. Now back to regular programming. Very pleased to welcome back to Forward Guidance Jens Nordvig, founder and CEO of Ex-Ante Data and Market Reader Inc. Jens was formerly a managing director at Goldman Sachs, as well as head of research at Nomura and Bridgewater. Jens, great to see you. Welcome back.
Thanks for inviting me.
My pleasure. Jens, last time you were here, you had a bearish view on the dollar and a bullish view on yield. So dollar down, yields down. That played out up until about January. But I want to take a little about face away from the US and talk about Japan, because as you were just mentioning, I think a lot of people have a little bit of fatigue from the Federal Reserve in America. So let's go over to Japan, where the yen has been weakening against the dollar and yields have been going up. So tell us what's going on in Japan for people like myself who might have missed it.
Well, so if you don't mind, I'll take a step back. More than 10 years ago, we had a thing called Abenomics in Japan, right? That Abe was elected as prime minister at the end of 2012, and then he had like a very ambitious plan for getting Japan out of deflation after, at that point in time, already a very long period of sort of deflationary forces. There were all kinds of aspects to this. He appointed the very aggressive central bank leadership, Kuroda, right, that put in place the most aggressive QE the world has ever seen. And the Bank of Japan bought most of the Japanese bond market, literally. And there was reforms in the corporate sector, trying to get governance standard in line with what they were in the US and so forth. There was a goal to get, women, labor force participation to work, get wage growth to be higher, all kinds of very ambitious goals. And here we are, 2024, and it didn't happen like a month after Abe was appointed, right? But after a little bit more than 10 years, I think it's fair to say that all those ambitious goals have pretty much been achieved at this point, with the last one that really comes into view now is what's going on with wage growth, right? So we can read about it in the news, right? The wage growth numbers that are coming out from the negotiations that are being completed here in the spring talk about 4, 5, 6% wage growth, right? And you have to go back a long, long, long way in Japan to find any wage growth that has been of that magnitude, literally to the early 90s, right? So we talk about 3-4 decades back to see something that's similar to what we're seeing now, right? So where we are in Japan, big picture is that a lot of indicators, a lot of macro trends are now looking more normal in Japan. Not Japanese special, but actually looking more like the rest of the world. And with a lag, we're going to have financial markets, the Bank of Japan, responding to that. Interest rates are still zero in Japan, right? That they moved them up from minus 10 basis points to zero, right? Not a huge move. And there's a debate about whether interest rates should really be pushed into positive territory. But it's quite remarkable that all the changes that we've seen have materialized a bit like Abe envisaged back in 2012. And nevertheless, we have zero interest rates, right? So lots of interesting things going on in Japanese markets. And the backdrop really is a historical normalization. It's going to be a ride when the policy normalization finally kicks into gear. And this is the year where this is going to happen.
So with the Japanese 10-year going from below 0% to now 1%, pricing in that stronger economy, stronger nominal growth, stronger inflation, and maybe future Bank of Japan policy hikes down the line, is it safe to say that what Japan may face is your base case for Japan, what the rest of the world, and particularly the US, did in 2022, where it's time to get off zero?
After such a long period of inflation being below target, like substantially below 2%, like there's been a great deal of skepticism that Japan could ever escape from that deflationary trap. But don't forget, we also had that skepticism in all the other countries in the world, right? We had the now, I would say, infamous shift in Fed policy framework to flexible inflation targeting, right, where they tried to promise that rates were not going to be raised anytime soon, right? Tried to do more forward guidance, and that was really based on a deflation fear, right? Oh, we have to be as easy as possible for a long time, right? And then eventually inflation exploded, and that turned out to be a wrong framework, right? And I think the psychology in Japan smells a little bit like the psychology we had, as you said, 2, 3 years ago in many countries. And there's a fear that we've not broken the deflationary psychology yet. There's a fear of moving too fast. But we've now had more than 2% inflation for like 2 years, right? And the wage growth is only kicking in now. So I think it's fair to say that even though Japan is different, demographics are different, so forth, we're going to have at least a period of 4 or 5 years where the inflation dynamics can be totally different, right? Because this wage growth that is now in the pipeline is going to have an impact on services prices in the next couple of years, right? And as we've seen in the US and the UK over the last year or so, right? Like, I wouldn't call it a wage price spiral, right? But there's some interaction, right? Once wages start to go up, there's going to be some services prices that go up, right? So this is not going to be over in a year. We're going to have a multi-year period ahead of us where there's going to be some price pressures, and probably it's not appropriate to have zero interest rates in that environment. And we could see obviously how the yen is behaving. It doesn't look like the yen is thinking zero interest appropriate. And I think also one thing that's really interesting is that if you look at what's going on in the banking system in Japan, we have very decent lending growth in Japan. Like, so in the US, we have essentially no bank lending growth. There might be credit in other parts of the economy, but there's no growth in bank lending. It's like just flat. And in Japan, we have, credit growth is growing around like 5% year on year. So it's kind of like it's flipped. Like, we used to have lending growth in outside Japan. Now we don't have that outside Japan, right? Because interest rates have been risen for a reason. That's how you see the transition into the economy. But in Japan, they still have an incredibly easy policy. In fact, you can argue that policy is getting easier and easier, right? Because as inflation rises, the real interest rate is actually going down. And certainly in the short end of the curve, right, real interest rates have gone down substantially as inflation and inflation expectations have risen. So from that perspective, it's totally logical there's more bank lending, right? You want to borrow if you know the price level is gonna kind of essentially take care of your debt service over time, makes it easier to service the debt you're taking out now.
Just looking at simple Japanese year over year inflation, it used to be either deflation or 1% inflation, so too much deflation and not a strong economy. It picked up to in 2022 to 4%, and now it's at 2%. So it year over year, simple headline inflation has gone down, but maybe your readings. I mean, I know you and your team at Exanta have done a lot of work on just the core inflationary forces of the wages. So maybe we can put up a few of your charts and take a look here. But the chart I believe you were referencing was the salary demand, showing that wages are going at around the Shinto agreed salary increment is at 5%, the highest it's been since 1990, and it used to be 2%. So tell us your view on, even though year over year headline inflation has declined from 4% to 2%, you still think that the core inflationary forces are still there. And then you've also got charts on real wages, which appear to be negative, but I'm curious your views on that,
Yeah.
as well as just change in cash earnings.
Yeah. So the global inflation dynamics that we have observed over the last 3, 4 years, right, initially had a big supply side component. Like, remember when there was a chip shortage, right? You couldn't buy any car at all. Used car prices went through the roof, right? And it was extremely expensive to ship. Containers were couldn't get into the port in Los Angeles, right? There was all those things that had to do with the COVID shock and the supply chain issues, right? Japan had that as well, right? And the big inflation spike that happened in Japan was that global effect. What's ahead is a different type of inflation, right? That we may not get to 4%, but the key is that we're escaping this environment where we had 0 to 1, that we have a long time, right? If we're going to have anything that resembles 5% wage growth, right, that's going to feed into services prices, right? And then it's going to be a different type of dynamic than the one I just described. It's going to be the demand driven, homegrown cost pressures that is driving inflation as opposed to a global supply shock, right? So that's the period we're heading into. The Bank of Japan is waiting for these wage demands, the negotiated wages that have been in the news over the last couple of months, to filter into the official wage statistics. That's going to take some time. It's going to take some months before they have a better feel for what's going on with that. That's something that is highly likely to play out and highly likely to influence how the Bank of Japan is setting policy, right? So the big picture is that we're shifting from essentially a regime a couple of years ago when we had supply-driven pressures in Japan that were externally driven, to now it's their own dynamic, and actually the dynamic where it makes sense to have a monetary policy response, whereas just externally driven, do you really want to have a big monetary policy response? I think they've probably been correct to delay that response, but now it's going to be domestically driven and makes sense to have a policy response.
In the US, it's, I mean, I really don't know, to tell you the truth, how it's measured, but it's everyone's salary and wages is measures, whereas this is, it seems like certain in Japan, certain industries negotiate wages on behalf of everyone. It's like massive trade unions, but maybe different companies. Explain how that works
Yeah.
and how it kind of will affect future wages.
So in Japan, as you know, they have a number of very large companies, Toyota and so forth, right, where they have employees that make wage agreements across the board, right? So what we see in the news are those wage agreements that are typically dominated by big manufacturing companies, Toyota, Honda, and so forth. That doesn't mean that those are going to be the wages that everybody else in the economy is going to have, right? But there's a pass-through into the broad economy. And that's actually what's shown in that chart. That pass-through into the economy has gone up. So if anything, the signal that we're getting from the negotiated wages in terms of what is likely to play out in the overall economy is a signal that is becoming more reliable, more relevant over time, right? So I think it's also worth just keeping in mind, right, that the labor market in Japan is incredibly tight for many, many different reasons, right? So Japan has historically had a very strict immigration policy, right? So they don't import a lot of foreign components of the labor force, right? They obviously have demographics that we're all aware of that was part of their whole economics theme, right? That they wanted to increase the female labor force participation. And they have, by the way, it's like now gone dramatically up relative to the US, right? So they've done a lot there. People stay in the labor force and work into older age as well. So there's lots of things they've done, but they're probably getting to the limit of those sort of more temporary ways of boosting the labor force, right? So they have a very, very tight labor market. And it makes sense there's wage pressure, and that's what's coming through. So I think all those anecdotes, all that evidence we're getting is consistent with a labor market that's going to generate more wage growth in the next couple of years than we've seen literally for 20, 30 years. That's where we are.
Inflation is finally coming to Japan.
I think we're going to finally have an escape from the deflationary decades. Then there's a question of what's the appropriate response to that, right? So I think the first response to that is warranted is you say, okay, we want to have less easy policy, right? You don't want to have real interest rates going down, down, down with constant inflation expectations going up. So you want to adjust that. So at least to have the nominal rates being commensurate with what the inflation expectations now are, right? So if we're just going to do very simple math, right? If we used to have almost zero inflation, right, and we wanted to have a low real interest rates, maybe also around zero, right, then you want to set the normal rate to zero, right? So if we have inflation that is now getting anchored around the 2% inflation target, and we still want to have accommodative real interest rates, maybe the appropriate nominal interest rate is too, right? So like there's a lot of talk about, oh, okay, in Japan they have a lot of debt, so you cannot raise the interest rate at all. From a debt dynamic perspective, to simplify a little bit, but the main thing that matters is where the real interest rate is relative to the real growth rate, right? So I think it is certainly the case that even if you have concerns about debt and debt sustainability, we can still go down a path where at least the nominal interest rate gets adjusted relative to how much the inflation expectations have adjusted, right? So if zero nominal rates were consistent with zero inflation in the past, we can certainly get to 2% interest rates without the debt dynamics problem being one that sort of obstructs monetary policy from operating normally. And I think that's kind of the learning process markets are going through this year, right? That people just can't believe that the inflation is actually coming, and people can't believe that any type of policy normalization is possible given this debt dynamic issues. But I think it all comes down to inflation expectations. If inflation expectations are different, then what actually constitutes easy monetary policy is also different, and we're going to have an adjustment.
Now, can you explain what's been going on with Japanese yields? The dotted line is the yield curve control, YCC. The black line is the 10-year. The gray line is the 2-year. And the dotted blue line is the 1-year short-term rate. Basically, they're all going up. And the 10-year yield is what was controlled by yield curve control. The targeted rate, I believe, was 0, but they had bands, and then they widened the bands, and then they widened the bands further. Can you explain, is yield curve control effectively over? Why did that dotted line end in October? And how high do you think yields can go?
Yeah, so let's take a step back and just describe, okay, why did Japan have yield curve control? The reason Japan had yield curve control was that it goes back to Abenomics again. When Abe decided to kind of shock the economy and fire the different arrows and stuff to kickstart the economy, they embarked on a very, very aggressive quantitative easing in 2013. And then they did that in 2013, 14, and so forth. And at some point, the quantitative easing, the amount of bonds that they were buying was so large that they literally couldn't find enough bonds to buy. They ran out of bonds to buy. That's how aggressive the QE was. So in response to that, the Bank of Japan said, "Oh, we want to be very easy, but we can't continue to buy bonds at the pace that we had done for a couple of years." So they said, "Okay, the best way to be easy is to just anchor the yields at a low level." So they anchored the short rate at minus 10 basis points, and they announced an anchor on the long rate where we had a ceiling on the yield, right? And the yield curve control ceiling has then been drifting up. That turned out to be kind of like, over time, an obsolete policy, right? That policy was literally meant to be one that generate maximum easy policy in a world where you couldn't quantitatively buy as many bonds as in the past. But it also meant a kind of bizarre situation where if there was upward pressure on the yields, they actually were forced to buy more bonds to counter that pressure, right? So if the economy was doing very well and there was some upward pressure on yields, they actually had to buy more bonds, in fact, inject more liquidity in a situation where the economy probably didn't need the liquidity, right?
So it's pro-cyclical. There's money when it doesn't need it.
Yeah.
And there's, yeah.
The better the economy was doing, the more liquidity they had to inject based on how that yield curve control was set up, right? So like grotesquely pro-cyclical, right? So it really was a matter of time just to get rid of that policy that was obsolete. But once you know how it is with currency pegs and pegs of other things, interest rates, right? Once you have the system, it's hard to get rid of it. So they were very cautious, but they moved the ban, and the market was okay with it, right? And now we effectively don't have it anymore, right? So that's why that black line, that where the 10-year JGB yield is breaking 1%, is what's historical, right? Because it really shows, okay, we are done with the yield curve control. The Bank of Japan is still involved in the market in the sense that it's buying JGBs, reinvesting its portfolio, so it's not doing QT, it's not shrinking the balance sheet. So there's still some bond buying they're doing, and when there's government intervention, right, the market's always trying to figure out, okay, what's their reaction function, right? But what we can see from the chart there is that there is no specific ceiling at 1% anymore, right? So in a practical sense, yield curve control is finally dead. The market understands it's dead, and that's a historical thing, right? Because we've been living with that arrangement for quite a few years, and the exit, I think, actually has been less tumultuous than some people feel. People thought there was going to be massive gaps, but they've been unwinding that policy. Yes, it's not that it hasn't been a challenge, right? But we also haven't had disorderly markets, so it's been a mostly orderly adjustment.
And so you think that economic conditions of higher nominal growth and higher inflation would be there for bond yields to go up, and the ceiling set by the Monetary Authority, Bank of Japan, that interest rates aren't going to exceed, excuse me, bond yields aren't going to exceed a certain level, that is practically gone. So would I take it that you are a pretty large bear on Japanese 10-year yields? Do you think yields are going to continue to rise?
Yeah, I think so. You can analyze the Japanese yields in different ways, right? So one simple way to think about, okay, where should Japanese yields be, would be to say, in the period when they didn't have yield curve control, how is the 10-year rate related to what's going on in the short end of the yield curve and global yields, right? If you do a simple model like that, you'll probably get that JGB yields should be 30, 40 basis points higher. But that doesn't even take into account where the short yield should go. If the short yield goes up as well, then you'll get like a different number there. So I think there's still a lot of asymmetry in this market, and I think it makes sense to there's the fair value, simple fair value calculation there. So again, this is one specific thing about fair value, right? If you have a different view on where the policy rate in Japan will be, then that creates additional upside risk relative to what's embedded in that chart there. And I think that's really interesting. I think the interesting scenario to think about in Japan and for the Bank of Japan is to say, okay, I think they continue to want to be cautious. I think they continue to want to be kind of a bit reactive, right? They see the data coming out, they react to it. They don't want to be too proactive in terms of like doing something too early that's going to create turmoil, that's going to create too much tightening. So they want to react when the wage numbers come through in the official statistics. They would also like to see, as you mentioned earlier, that we've had negative real wage growth in Japan. There's an expectation there'll be a turning point with better real wage growth, better consumption next couple of quarters. Once they see those things and inflation forecast kind of starts to drift above 2, they normalize policy. And the little tweak they did earlier this year when they went from -10 to 0 interest rate, like maybe they'll do another step that is like from 0 to +10, like very, very small steps. But then if the data continues to come out in a more normal way, like it is doing in other economies around the world, maybe they'll move to 25 basis point steps. And the real surprise would be if you have a tightening cycle in Japan where, okay, maybe they have to go, 100 basis points within a reasonable time frame, 150 basis points within a reasonable time frame, maybe 200 basis points. And I'm saying this 200 basis points, right? Because it wouldn't be crazy to have 2% interest rates. If inflation is around 2%, that would still be 0 real interest rates, right? And those are the scenarios that the market have had very little probability on. those are the ones I think investors should think about. Okay, what's the probability of that? Maybe you don't think it's the central case, but maybe it's 40%, something like that. And that still would mean that the curve should be priced quite different than the case is the case now.
Forward guidance is brought to you by VanEck. The VanEck Morningstar Wide Moat ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? Moat strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar Wide Moat ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks, let's get back to the interview.
And so the Bank of Japan is set to meet on June 13th. And later on in June, you get some more summary of opinions. Your base case is 20 basis points of cuts. Is that what I gathered?
Yeah, so the hiking cycle is, I think it's going to move slowly, right? Because it's such a long time since they've been down this path, right? So I think the first step could very well be 10 basis points, which is not going to change the real interest rate at all. It's going to be just a signal about stuff is changing, right? So the actual 10 basis points not going to matter at all. The signal about the future could be meaningful, right? So I think most likely path is probably one where we get the ball rolling with 10 basis points, right? And then they'll have to consider, okay, how many 25s do they do? The market's roughly pricing, 110 plus another 25. So very, very cautious. And I think the real risk is that they do 10 and then we have a series of 25s, right? So could be by the end of the year, like we could have like 75 basis points of tightening, right? It's not priced at all.
Do you have a view on what the terminal rate may be for the Bank of Japan? In other words, how high they're going to go? For example, if at the beginning of 2022, someone said, "Oh, I'm bearish on interest rates. I think the Fed will hike to 3%." That would have had a ridiculously bearish view because interest rates were at zero. Of course, they've hiked to 5.3%, so much, much higher than expected. How high do you think the Bank of Japan will go with the policy rate?
So I have a joke that I've been sending out on Twitter many times over the last couple of years. That is, nobody has a clue what the terminal rate is, and I've been saying that for years now, right? And people made projections about, okay, how high was the Fed going to go, right? And initially people thought, okay, they can go all the way to 2%. And then a couple of months later, say they can go all the way to 3%. And then they revised their views and then they can go all the way to 4%, right? And we ended up at 5.5%, right? And we actually even have debate now about whether 5.5% is enough, right? And they go to 6%, right? So terminal rate is a hard, it's a hard thing. So I think from an investor perspective, the key is to think about the probabilities. And I think, okay, if you want to think kind of out of the box in Japan, you should say, okay, maybe the terminal rate could be 2.5, right? That will be dramatically different from all the terminal rates that people are thinking about now and what's embedded in the curve. Maybe it could be higher than 2.5, right? So I don't think we know, but I think the key point is that this notion that Japan is going to be opposite every other economy in the world, right, and not be able to hike interest rates at all. That is the narrative that's being questioned. That's the old narrative, right? And I think that is going to likely go out of the window in the next few months. And then the debate about what the terminal rate is going to really start to come into play, right? But if we have inflation in the next couple of years that is 2% or above, then some kind of normalization of 200 basis points would certainly seem very logical, right? And that wouldn't even be a tight policy. That would just be getting the real rates to be stable effectively, right? So I think that's the most likely scenario. And I think if we bring in the yen into the equation here, that's also a situation where you don't necessarily get a lot of tightening through the currency. Like, if you just have a situation where the central bank is kind of reacting to the data that's coming out, we need to adjust the normal interest rate level because the the inflation level has shifted, right? So in order to keep real rates more constant, we need to have the normal rate be recalibrated with the inflation level, right? And that's kind of what's going on in the market right now. Even if it looks kind of dramatic what's going on with interest rates, is it benefiting? Not really. Like, it's a pretty amazing situation we've had where we don't have the official data yet, but the Bank of Japan probably like spent $50 billion intervening in the currency, right? And you literally cannot see it in the chart. And I think what's fundamentally going on, right, is that we obviously have the pressure from global rates that is typically damaging low yielding currencies like Japanese yen, Swiss franc, some other Asian currencies. And then you have some kind of optical offset from the Japanese yields going up. But since they're just going up with their own inflation expectations, it's not really generating any juice that's supporting the currency yet. And I think you could have a situation where the Bank of Japan is reacting to the different inflation regime, recalibrating their interest rates, but the real interest rate will not move. That means that the yen will stay quite weak, right? So they don't get the tightening through the currency. And that actually means that over time, they'll have to do more nominal adjustment. But again, it's just a kind of recalibration to what the inflation expectations are. So we'll get the official data pretty soon as to how much money they spent, right? But it's expensive to intervene in liquid currencies, right? So you have work a couple of days, right, and cost $50 billion. When they did it back in 22, right, they intervened on a couple of occasions over 2 months, right? And it was also in the region, call it $60 billion round numbers, right? So like the debate we're having now is that we've had dollar yen go back up to 157, the intervention level that we saw a month ago. I'm just checking on my screen here down that we're still at the right level. Yeah, we're right there, just below 157 still. They could intervene any day, really. Like we have a model that we like to use where we sort of say, okay, what's going on with the yen that is in excess of the typical fundamental drivers, right? So we look at what's going on with global interest rates along the curve. We look at what's going on with the dollar as a kind of anchor currency. And then we look at the deviation of the yen from those forces. And we've had essentially that the yen residual has gotten pretty big again, and you literally cannot see the intervention. Like the intervention was visible for a couple of days and then came out. So from that perspective, if they want to fight excess yen weakness, they should be coming in to again, anytime really. But the trick is, how much do they want to spend on it? So they obviously have more than $1 trillion of reserves. You obviously don't want to spend reserves down to zero, right? So how many days can they really come in? So if it costs 50 billion for a couple of days, like maybe they have a couple of days in addition that they could do, right? But it's not something they can do for a sustained period of time. So it's something they're going to do to calm the price action down. So I think the catalyst for intervention is that the excess yen move is already significant. If it starts to accelerate, I think it'll come in again. But I don't think that's something that's going to turn the trend.
Okay, so you're saying that, so just background, the yen has weakened. It was 104 yen to the dollar in the beginning of 2021. Now it's 156 Japanese yen to the dollar. And when the Japanese yen weakens against the dollar or against other foreign currencies, that is net stimulative for Japan. And so you're saying that the Bank of Japan raising interest rates, that would cause a strengthening in the yen, which would contract Japan. But you're saying that hasn't really happened. So therefore, the Bank of Japan would have to hike even more because you're not getting that currency effect of, for example, when the Federal Reserve shocked the world by hiking so much in 2022, the dollar spiked up, and that was a net slowdown for domestic producers.
Yeah, so we're used to looking at relationships in the currency market, right? Where if there's a unexpected monetary tightening, we have currency strength. That's the sort of standard relationship, right? And people are used to looking at correlations between, okay, what is the 2-year rate doing and what's the currency doing? And we have a positive correlation there. So that's pretty standard. For EM, it tends to be different because interest rates move for different reasons there. But for the yen, that's actually the currency out of any currency where the linkage between rate differentials and the currencies is one of the strongest, right? But the reason why that link is complicated is that if the Bank of Japan is raising rates, but raising them so slowly in 10 basis points increments that they are barely catching up with the inflation, then there's a difference between nominal interest rates going up and real interest rates going up. So what you normally see in other economies is that what they're doing with nominal interest rates is mirrored into the real interest rates, right? But that's where Japan is different. They're so slow. They're reacting to the inflation expectations and really so far just keeping real interest rates stable at a very low negative level, right? And that's why the currency hasn't reacted. And if they continue with that defensive way of doing policy, reactive way of doing policy, then I think they will actually need to do more over time, right? Because they don't have the shock effect, they don't have anything dramatic, they don't have the currency moving, and over time, that means that they actually need to do more on the nominal.
Got it. And earlier you referenced them spending, billions on defending the yen. Explain why I believe it is the Ministry of Finance, MOF, which instructs the Bank of Japan, who acts on the MOF's behalf, to defend the yen, i.e., make sure that the yen doesn't weaken further. And also, you said that they might run out of money. I mean, central banks, are they using their reserves to defend their currency, or are they just kind of printing it out of nothing like they do for QE?
Yeah, so you're right. And when you go to Japan, so I used to be a currency strategist for Goldman. I used to do research for Nomura, right? Then when you go to Tokyo, you typically have a meeting at the Ministry of Finance, right, where you talk about what's going on in currency markets. So they have a group of people at the Ministry of Finance that is solely focused on monitoring currency markets because they want to be ready to intervene when they think it's appropriate to do so, right? And so they make the political decisions, right? And then the actual execution is happening with the Bank of Japan, where they have the funds. the central bank reserves are the ones that are used for this purpose, right? So yeah, it's a relatively straightforward process, right? Where they have a pool of assets that's in foreign currency that they can use. In the current environment where there's focus on global bond yields being on the move, we get a lot of questions, certainly, okay, how is the yen intervention funded? Do they have to sell any bonds to fund it and so forth? I think in 2022, there was some evidence that there was some selling of US treasuries to fund the intervention. I think in this intervention, it's been a little bit less clear whether they have needed to do so. They, as a part of central bank reserves, have a mix of securities and deposit holdings, right? So maybe they had enough deposits, repos, and so forth, where they could just source the liquidity without selling any bonds. But obviously, if they need to do big scale, they would need to sell the bonds. So those are the sort of basic mechanics around it. If you do a standard currency selling operation, you'll absorb liquidity in the process, right? So that's sort of the standard way of doing it.
I saw some news when Treasury Secretary Yellen was in contact with the Japanese, and the Federal Reserve extended some swap lines to Japan. Is the U.S., either the Treasury or the Fed or both, assisting or working in concert with Japanese officials on managing the currency?
No. So the last time there was any coordinated intervention in the currency market was back in 2011, when we had the earthquake and the tsunami that caused all kinds of havoc with the nuclear disasters in Japan. And we had a coordinated intervention back then. It was kind of like a natural disaster, right, where market needs to be stabilized. The yen was getting too strong back then. But that's not the situation we have now. And I don't think there's any international appetite to support what's going on. The yen is weak, but it's weak for a pretty logical reason, right? Japanese interest rates are zero, and we've gone from 0 to 5.5 in the US, right? It's very logical that the yen is weak. There's nothing really to fight there. It's been even though the move has become big over time, right? It's been pretty orderly along the way, so there's no financial stability considerations either. And the logical thing to do, if you're concerned about your currency being too weak, would be to move interest rates as opposed to intervening, right? So I think having global coordinated intervention is impossible in this environment. I think that's also something we can see in the central bank communication, that there's starting to be more and more focus on whether the yen is going to impact the inflation outlook, and whether therefore there is a need to speed up the interest rate normalization, right? So the Bank of Japan is not going to say we're managing the yen with interest rates, but everybody knows, and you can talk about that explicitly as well, that there's a transmission. Okay, when the yen is very weak, import prices go up, inflation goes up, and obviously the inflation forecast is going to impact what they do with interest rates.
It sounds like you are a significant, dare I say, massive bear on Japanese rates. What is your view on the Japanese currency? Do you think the yen will continue to weaken against the dollar, or do you think it could hold that level in the mid 150s? And also, it's priced for appreciation. It's priced to go down, right? Because it has lower rates.
Yeah. So where the forwards are sitting is just a mathematical function of what the interest rate differential is, right? And that's another way to phrase the same thing, right? Is there's obviously a carry trade to do, right? You get paid to be short the yen. I think we've had a very big move. I think we're at a point where the inflation news is such that normalization is around the corner. The level of the yen is also helping speed up the interest rate normalization, right? So I think there's going to be efforts to stabilize the yen, but I don't think necessarily that the yen is going to be appreciating dramatically, because it's going to be reactive, slow, defensive. So the trades that kind of come out of that are carry type trades where you think the yen is going to be in a range, right? And you can fund in yen. But you want to be precise, right? Because it's going to be better to fund the day they are intervening, as opposed to right before they're intervening, right? So the ideal way to time it is say, okay, they're going to squeeze. Every time they intervene, it tends to move like 3% on the day, right? It's a pretty systematic pattern, 3.5%. So if you can come in and do some yen trading around those days, that's the more interesting part, I think, rather than having a big directional view right here. But from a funding perspective, I think probably still makes sense to fund, especially if you find those more interesting data points, either on the back of risk aversion globally, or on the back of them coming in and pushing those temporary dips 3.5% as they often do.
So it probably makes sense to fund, meaning borrow yen, meaning short yen.
Yeah, like for example, like if we think about what's going on in currency markets, right, on a global scale, we've had some better EM trends over the last few months, right? So there are a number of investors that like to be long, high yielding currencies like Mexican peso, for example, right? So if you want to be along Mexican peso, it makes a difference whether you are funding that trade in dollars that cost 5% or yen that cost 0%, right? So if there's stability in dollar yen, obviously you get a lot of extra carry from doing the yen funding. The risk obviously being that we have a big appreciation. So that's why if you wait until the next intervention is there and you can get a 3% discount, that makes that proposition more attractive.
So if you're a yen bear and the yen stays where it is, you would still make money just because it's you get positive carry by being short the yen. My next question is about what are the implications on U.S. markets, particularly the bond and treasury market. Japan has been a massive buyer of U.S. fixed income assets, not just treasuries, but CLOs. I think agency mortgage-backed securities and the like. I don't think they have been there in the same way and had the same presence over the past few years, even though the yield differentials got massive and people were saying, oh, Japanese investors, they're going to be buying 5% treasuries hand over fist, but not so fast because if they were to hedge it back into yen, the pickup would actually be negative. So they might as well buy a JGB. Everything we talked about so far, how does that impact demand and appetite of Japanese investors for U.S. treasuries?
Yeah, so I think when you analyze the capital flows between Japan and the U.S., you have to be careful about trying to understand. Okay, is this like a pension fund that buys a treasury and holds that treasury with the currency exposure, i.e., owns dollars, or is it some other entity that actually funds whatever it does in U.S. fixed income out of dollars, right? So that could be Certainly, there are big Japanese banks that have big balance sheets, right? That in the past they've done curve trades, right? So they've borrowed short and short dollars and taking duration risk, right? So that duration curve trade is no longer profitable, right? So there's a lot of the capital flow that you can see in the official data that is effectively, curve trades are no longer viable, but it's not really a cross-border thing, because if it's like a US branch of a Japanese bank that is shutting down that curve trading, right, that doesn't really impact the yen at all. That's just actually something that's going on with Japanese entities in dollars. But so where it comes into play, I think, has more to do with what are the term premia that we have in global fixed income markets, right? So it's been very fashionable over the last couple of years to do supply analysis in the US bond market. I think you have had many guests that talk about that, and quarterly refunding and all those types of things. And I think one part of the equation there is that we've had low Japanese yields and previously looked like very low European yields, like was kind of an anchor on how high US bond yields could go. And now we have some movement, right? So in the last couple of weeks, the 30-year in Japan has shifted up dramatically, much more dramatically than the 10-year. So that means that finally Japanese investors actually have an alternative in their own fixed income markets that can really actually generate a respectable yield, especially if you're an insurance company or something like that, very, very conservative portfolios. So I think it has an impact on what term premia are, right? Because you don't have the sort of very sticky demand from all kinds of different Japanese institutions. And this is a process we're going through. We finally have term premia starting to build in yield curves, both because of supply issues in the US itself, but also because these very depressed yields around the world are disappearing, with Japan being sort of the last one standing that is also evaporating now. So I think term premium is a very relevant dimension. And then I think something that we do at Exante Data, like we're very, very focused on tracking global capital flows. We have a lot of proprietary indicators where we track capital flow in high frequency, right? So what we're watching very, very carefully now is whether there's any evidence of any dramatic shift in portfolio flows. Like, are we going to get to a point where Japanese yields have moved so much that there's a kind of repatriation back into Japan? I don't think we've seen anything like that, but I think that's something that should be on the radar. If we get to that point, then you could start to embed more of a spillover effect beyond the sort of more medium-term risk premium effect, like a more short-term flow effect as well. So I don't think we're quite there yet, right? But I think that's why having this tightening cycle, or at least normalization cycle, in mind, how that's going to play out over the next couple of months in Japan, could certainly be relevant for global fixed income and be something that could have flow effects when those effects start to accumulate and impact Japanese investor behavior more.
Thank you. So just to put a point on it, all things being equal, which it very, very rarely is in economics, but if Japanese yields go up, that is a net bearish move for other global fixed income assets, for example, U.S. Treasury rates.
I think like all global fixed income markets are correlated, right? You can model that in different ways, right? So clearly, if you have a big shift in JGBs, it's going to have an impact. I think that's not very controversial. The controversial part is how big is the effect, and I think, I think there's kind of two pieces to that. There's the underlying equilibrium calculation that the global fixed income manager is doing, and then there's a second effect that comes into play if there's sort of a more abrupt asset allocation shift where Japanese investors say, okay, we actually don't need as much US exposure anymore, and bring that money back. So that second effect, I think, is something to worry about, and maybe in the second half of the year. I don't think it's going to come into play in the next few weeks, but the second half of the year, if the Bank of Japan feels that they need to go into more normal monetary policy cycle, I think that could be relevant and something that's worth watching in the flows.
And Jens, you and folks at Exante Data have done a lot of work, very in detail, on the maturity profile of the Japanese government's debt, as well as the Bank of Japan's holdings of those debt. I mean, we could put on many charts that you've got there, but what are some broad conclusions that we can draw from, i.e., what is the maturity profile of the Bank of Japan's holdings, and how is that going to impact everything we've so far discussed?
The broad conclusion is that you're going to have a monetary policy impulse that's going to be essentially supported from a flow dimension in terms of the amount of bonds newly issued from the government that the private sector has to absorb is going to go up dramatically. It's almost like we had 20 years, right, where most of the bond supply was absorbed by the public sector. And now we're going back to where we were in essentially the pre-global financial crisis period, when the Japanese private sector had to absorb a lot of JGBs, right? So it's a long, long time since we've tried this. And I think that also suggests that essentially the term premia that have been behaving very unusually in the Japanese yield curve for a while, from a flow perspective, they are set to normalize. So I think that's really interesting. And I think it's not getting enough attention how big that shift is, right? Because people say, the Bank of Japan is still buying bonds, but they're just buying bonds for reinvestment. That's a huge difference from actually taking out a lot from the new issuance that the government has.
Yeah, you're saying they're holding it flat.
Yeah, they're holding the balance sheet flat, right? We still have a big fiscal deficit in Japan, right? So somebody has to take those bonds down. And it's essentially 20 years since the private sector on a net basis had to eat a lot of bonds. So there's going to be a big meal in the next couple of years here, and it's going to require high yields, and that's the adjustment we're starting to see.
And is that because the maturity or tenor profile of the Japanese bond market is very short duration, so a lot of them have to be refinanced?
Yeah, so we've had some extreme situations around that in the COVID shock, where there was massive T-bill issuance and so forth, right? But the real issue is that the Bank of Japan has gone through a historically large QE. Like you can see it in that chart, like the run up in JGB holdings in the period from 14 to 18 was extremely dramatic, and then it slowed down a little bit, but it still continued, right? So the slope of that curve you're seeing there has been very steep for a number of years, right? And we're finally getting that to be flat. And the private sector has to be the mirror image of that, right? So they have been flat until recently, right? And they had to get steep now in terms of how they're accumulating.
Got it. And Jens, actually, well, first of all, yeah, we've got this great chart. I just want to show it of the matured versus maturing Japanese government bond holdings. I don't know exactly what to draw from that, but it's a beautiful chart. Really, really a great chart. What about this narrative that we so often encounter, that because the Japanese debt to GDP ratio is so high, above 200%, they can't raise rates? And that is something that, to me, when someone says that to me, it makes sense. The debt to GDP ratio is so high, they can't afford to raise rates. But seeing, doing this for a few years, I've learned to become wary of narratives that makes too much sense when you first hear them. So what do you think about that as the huge stock of debt as a impediment to the Bank of Japan hiking rates? And then what is this chart that we have here that shows your forecast for the Japanese debt to GDP ratio depending upon interest rates? What can we glean from that?
Yeah, so I think maybe just focus on the gray line. That is the middle scenario, right? So this is just a simple debt to GDP sustainability analysis, like similar to what the IMF would do, and it's actually based on some IMF assumptions, right? But the key thing is, if you focus on the gray line there, where you say, okay, what happens if all Japanese debt is now issued at 1.5% coupon on a forward-looking basis? Is the debt dynamics going to explode? And the answer is no, right? Because if you have a nominal growth trajectory where you have 2% inflation, right, and some real growth, that actually means that interest rate is relatively low, right? And you're going to have a debt to GDP trajectory that's actually going to be better than what you had over the last decade or so, right? So it all it's all to do with inflation, right? Debt dynamics are helped a lot by inflation. That's probably why some countries historically have liked to print money to get out of their problems, right? But this chart is just a simple illustration that you can certainly have the government issued debt around 1.5%, and it wouldn't cause a major issue. Even if you go to the 2% scenario there, you can see like the current level of debt would be relatively stable for the next several years. In that scenario, that's the yellow line there, right? So I don't think the debt sustainability is something that's going to be, dominating policy. I think there's some wiggle room as to where interest rates can set. Like very big numbers, 4% interest rates or 5% interest rates for Japan, you'll get dramatic numbers, and the red line there kind of shows you, okay, if you get to 2.5, you start to get into that territory, but we're not there yet. So I think the key message we want to say is, okay, you can't do debt sustainability analysis without taking into account the inflation trajectory. If you do that, we can have some normal interest rate normalization, and that's what the gray and the yellow line shows right there.
Very interesting. Jens, my final question for you is about the U.S. Last time you were on in November, you were a dollar bear and a bull on rates, so dollar down, yields down. That is what happened early throughout this year, but since then yields have been back on the move. Just really quick, what's your view on the dollar and let's say the 2-year bond yield right now, and why?
So I don't think the Fed is going to be in any rush. Like we've had 3 months of very strong data in the first quarter of the year, right? High inflation numbers, robust labor market numbers. I think it's going to require quite a bit of softer data for the Fed to feel comfort they need to cut rates. So I think we're still going to be in a situation where the basic framework for monetary policy on a global scale is one where the Fed is cautious. There's going to be other central banks that are cutting first. We've seen it already in Europe, like Swiss National Bank has cut rates. Riksbank in Sweden have cut rates, right? So they're clearly, there's a difference there. And I think that difference is going to remain. We have to watch what's going on in the U.S. economy. Obviously, at some point, the economy is going to turn, but I don't see anything in the U.S. data that's like a quick turnaround. It's like, I think what's going on in the labor market is a very, very gradual softening, but not something that's abrupt. I think from a dollar perspective, I don't think we have a catalyst for a big turn in the dollar. I think in the currency space, we're more focused on whether there's any carry trades we can do. I mentioned earlier, right, that, okay, maybe there's some very high yielding currencies that are actually attractive. There's some low yielding currencies that are under significant pressure. We're not just talking about the yen. We're talking about essentially most Asian currencies have been on a pretty rapid depreciation trend. I don't see why that wouldn't continue. One thing we haven't talked about a lot today, maybe we need to do another call, is China, right? So China is trying to stimulate their economy. They're trying to do some kind of rescue operation in the real estate sector, right? But this is a long-term process. It's not something that's going to generate a boom in the Chinese economy. And I think what you're seeing in Chinese currency market and Asian currency market is a reflection of that underlying weakness in China that is not going to be changing from one day to the other.
Thanks, Yen. It's been a pleasure speaking with you throughout this conversation. I think we put on a lot of display your work at Ex Ante, but you're also the founder and CEO of Market Reader, which uses AI to track the market and explain moves. Since we spoke in November, has there been any developments at Market Reader, either a new function or something you learned about AI? And because I know this space is moving so fast.
So actually, I'm going to say something that's slightly ironic. Like what we've learned actually is something about how clients like to get content. And we've actually figured out that the whole process we have at Market Reader, where we scan everything in the market and try to figure out what are the interesting moves and explain them as they happen, people actually like to get that content pushed to them in some form, an alert in some form. Even an email seems very old-fashioned, right? But people like to get it delivered to them. So we're actually launching some of these emails in the next couple of weeks. So if you go to marketreader.com, you can sign up for these newsletters. We have one that's pushed out. That's called the Market Reader Minute every morning. That's for free. And you can get an update on some of the big moves in the market. And we will launch very specific like emails. That is, if you're interested in tech, you can get the tech email. If you're interested in financial, get the financial email. Because we scan everything, we can produce these kind of emails essentially automatically, right? And have also the content being more timely. So check out marketreader.com. Maybe you want to get that update in the morning. So that's a new thing we're launching. And we have launched one version that's going to be more of them coming in the next couple of weeks.
There we go. People should check that out. Jens, thanks for coming on, and thanks everyone for listening.
Thank you.
Thanks for watching. Remember to check out vaneck.com/moatfg to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.